Thursday, March 18th, 2021, Monaco 64, home of alternative economics and contrarian views. So it looks like the bond vigilantes are waking up. The reaction to the Fed statement, the press conference, hasn't been great in the bond markets, especially in the longer end of the curve. Of course, the Fed can control short-term interest rates more easily than the long-term interest rates. I think there was a chief of staff for Bill Clinton. I think his name was Carville or something. Someone asked him, if you came back to life, if you died, what would you want to come back as? And he said, as the bond market, because the bond market is so important. So, yes, I think Powell failed to calm fears in the bond market about SLR, about doing more QE, even though his comments were very dovish. So overnight, we've seen the 10-year yield go up as far as 174. It stopped right there. I mean, 175 is usually a key level in the bond markets. You have levels like a quarter, a half, and 3/4. They are also usually important levels. Right now, we're at 172. So prior to the Fed meeting, we were around 162, 163. So it's actually gone up by 10 basis points. The short end of the curve, for example, the 2-year note yesterday dropped about 2 basis points to around 0.12, 0.13. Even that is up this morning here in London. It's up just over 1 basis points at 0.14. And for some of you who might not know, and I've spoken about this many times, why is the 10-year yield so important to the financial system? Well, first, the bond market is much bigger than the stock market. Second, the 10-year yield is supposed to be the risk-free rate of return it's the benchmark for the world. It's what a lot of securities, corporate bonds, stocks are priced off. That's the rate that people use to calculate the present value of future cash flows that determines the price of a stock or a corporate bond or anything else. So if that starts rising, it means that Uncle Sam has to pay more interest on its ballooning debt. More interest means more debt, because the only way Uncle Sam these days can cover interest and also pay the old debt is by issuing more debt. So it becomes like a snowball effect. When was the last time that Uncle Sam or any other country in the world could actually pay off debt with surpluses? I mean, I don't think the U.S. has run a surplus ever since Nixon closed the gold window. A budget surplus is something that if you search on Google, you probably will not find many results. The only country that I can think of that was in surplus in the last few years prior to the crisis that started last year was Germany. But apart from that, most countries are running huge deficits. So yes, the bond vigilantes, they've been put to sleep for many decades, actually, maybe almost 3 decades. In the early 90s, I still remember that the bond markets, we had rates that were more like normal, like 5, 6, 7% yields in the 10-year. But it's been more like since the century, and I think it's to do with the fact that the central banks, especially with the Bernanke helicopter speech, they've put a put underneath the bond market by saying that they're going to print as much money as possible to keep things going. The only way they can keep this everything bubble going is through lower yields. So this is a big thing. So this is how the FT saw the FOMC and FOMC's statement yesterday. It says Fed signals no rate rise until at least 2024, despite growth upgrade. Well, what about this growth? Yes, there might be growth of the GDP, which is totally driven by the huge deficits that the government is running. If you look at the GDP calculation, government spending is included in there. So the bigger the government spending, the more help it will give to GDP. So yes, I think the real private sector organic economy will not do well, and it's going to be the same thing here in the UK. You look at adverts for jobs, it's all jobs for the public sector, all jobs that would not have existed a year or two ago, jobs like a track and trace administrator, all this rubbish to do with this crisis, jobs to keep people employed, jobs that actually pay quite a bit. But it says central bank expects U.S. economy to expand 6.5% this year because of stimulus. There you go. and vaccine rollout. I'm not too sure how much that will help. So it says Federal Reserve officials signaled that they expect to keep interest rates close to zero until at least 2024, even as they sharply upgraded their U.S. growth forecast because of a massive fiscal stimulus and an accelerating vaccine rollout. So, and I think that they might even get more stimulus. There's talk of more trillions in infrastructure spending. And for that, read more, how can I say, non-jobs that pay well. For that, read more to government spending in the equation of GDP, and that's going to make GDP look better. But it's all artificial. So yeah, there are some people like a good friend of mine who lives and breathes the bond market. He's been in the bond market for all his life. He's worked in the city. He's very bullish bond still. He thinks, and I partly agree with him, that the economy is not going to recover well. But the markets might not think so. The bond vigilantes might not think so. He could be right. And I guess we've got to the end of this month for the Fed to extend this statutory leverage ratio. I mean, it could come to a crisis for the Fed to act, to maybe come out and say they're going to increase the QE on the longer end of the curve. But at the same time, this SLR is a problem. Someone sent me something, a research from Credit Suisse, saying that the SLR is not a problem because the bonds are held in the holding company of a bank, something to do with regulatory things. But I'm not too sure about that, because why would there be all this brouhaha about the Senate people like, what's their name, Warren and Brown, making a big deal about SLR, right? So yeah, I think things are gonna get quite interesting in the next few weeks, to say the least. Of course, the 10-year yield is the focus of everything right now, not just in the US, but all around the world. We are in the dollar reserve system. The Federal Reserve is the central bank of the US, but it's the central bank of the world indirectly. So with that, let's look at where the markets are this morning. I'm a little later. It's 8:43 a.m. London time. It's been frustrating for the precious metals because yesterday and overnight, gold did really well to the in reaction to the FOMC. We got up to 1756 overnight, and now I see that we're down 8 at 1736.30. So it's still, I mean, gold is picking up, because when we got down to I think it was 1675 or thereabouts, the 10-year yield was around 163. So now we're around 170, 174. and we are about $60 higher. So I think bonds, if there is a trouble in the bond market, because there's a difference between yields rising and a bear market in bonds. We haven't had one of those probably since 1994. There was a big bear market in bonds back then, and I remember it vividly. One of the victims was Orange County in California. They went bust because they had loads of derivatives to do with interest rates. So yeah, it's frustrating, but I'm holding on to my precious metals. I'm going to keep stacking, trying to keep stacking as much as possible, not only gold, but silver. Silver right now is at 26.30, up just over a cent, but it's been as high as 26.65, and we're right near the lows here. The Dow is up 10 points. The NASDAQ 100 futures down 160 or over 1%. S&P 500 is down 0.5%. So stock market not really enjoying these yields, long-term yields going up. Currency-wise, we've got sterling unchanged, 139.60. We've got the euro down 0.25% at 139.60. We've got the dollar up 1/3 versus the yen at 109.17. And we're pretty much stuck around 650 versus the yuan, the dollar is. High-grade copper is down 0.25% at 410. WTI crude is down 0.9 at 64.05. So yes, the market definitely did not like what the Fed came out with yesterday. So the Fed does have a problem, and we're going to have to keep a very close eye on that. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.